Recently, I came across this shopping center real estate investment trust, Whitestone REIT. Its share price remained depressed in the $8.50 range compared to pre-COVID levels of around $13 a share. I think this gap could potentially be closed, meaning it could translate to more than 50% upside. So thought I want to share with you why I'm starting to add some positions and why I think the closing of the gap in the share price is very possible. So very quickly, understand that Whitestone is a pure play community-centered retail REIT. And this is also the key reason for my investment, as it will be a safer bet than on shopping centers in urban areas focusing on international and luxury brands tenants. Because community malls like those that Whitestone owns are places where people shop for their necessities and services even during a time of pandemic, so they should be more resistant to any new strains of virus outbreak or any economic downturns. I will not dwell into too much details of the 58 properties that the REIT owns that span across 5 million square feet of gross leasable area, but understand that they are mainly located in Texas, Arizona, and Illinois. Observed from the chart here, the tenant mix are focused on providing necessities and services as well as entertainment to the communities in which the shopping malls are located. A good percentage of it are made up of restaurants and food services, while the others consist of services that are difficult to bring online, such as salons, medicals, and fitness services. In short, what I can say is that Whitestone is positioning their shopping centers and malls to be resistant to the e-commerce trends by providing experiential and lifestyle centers that the community can engage in. Now, going to the financial figures, you can observe the resilience of its properties with only 1% decline in revenue for the COVID hit 2020 compared to 2019. Similarly, occupancy remains strong at 89% compared to 90% in 2019. So just a side note, 2019 saw some disposal of properties in Whitestone's ownership of Pillartone, resulting in the significantly higher equity in earnings of real estate partnership recorded in fiscal year of 2019. Therefore, other than this one-time off gain, the REIT should register similar net income for these 2 years of comparisons, less the increased operating expenses recorded for fiscal year of 2020 due to higher depreciation and amortization expenses as well as real estate taxes. So, the funds from operations FFO figures will be more reflective of the REIT's operational performance. As observed from the table, 2020 FFO of $36.4 million is just a 4.2% decline from 2019's figure. This shows the resilience of its portfolio of shopping centers and malls when other sectors and industries face adverse business impacts due to restrictions and lockdowns. In fact, we saw Whitestone recovering strongly over the past few quarters from the initial shock of the pandemic outbreak. The drop in rental collections back in the second quarter of 2020 has now recovered back to a much healthier level of 95% as of the first quarter of 2021. Now back to its share price. Previously, Whitestone REIT had been hovering in the $13 a share range before COVID hit. So why has it remained depressed despite the strong performance of its retail properties? I would say that it can be mainly attributed to 3 reasons. The first reason is associated with its high debt leverage, with the debt to EBITDA ratio standing at around 9.2 times compared to the industry average of around 6 to 7 times. However, understand that its debt leverage has been similar in the recent years before COVID hit as well. The second reason why the REIT's share price remained depressed is because of its high general and administrative expenses. In fact, it is eating up 16.9% of its revenue for the fiscal year of 2020. Industry average should be between 8 to 10%. People are concerned that the management is paying themselves too much for the REIT of its size. However, again, this is not something new and it has been an ongoing concern and issue in the recent years, even before the pandemic outbreak. Definitely there are valid concerns, but what I am really trying to say here is that these first 2 reasons are already pre-existing before Whitestone's share price plunged in the 2020 market crash. And at the very least, we do see that management recognizes these problems and are trying to address them as seen from their strategic targets that they have laid out for 2023. So the third reason is really why I think the share price remained depressed and hasn't recovered to pre-COVID levels. And that will be due to management reducing the dividends payout by a substantial amount of more than 60% compared to the previous years. Well, personally, I don't think there's any issue with that so long as the business fundamentals remain strong and intact, which is the case for Whitestone. However, I understand that some investors focus on investing in higher risk, and that's the reason why its share price remained depressed, because some of these investors has built up from this ticker in search of higher yield investment elsewhere. So because of these 3 concerns and the reasons I've provided on why they shouldn't be a problem, at least for me, that I thought that Whitestone REIT's share price should revert to the $13 a share range before COVID. Meaning, there's a more than 50% upside from the current level of $8.50 a share range. The other key reason for me to invest in Whitestone is that it seems to be trading at a substantial discount to its net asset value. Based on its net operating income of $83.9 million and the estimated cap rate of 6%, this should translate to an asset value of $1.398 billion. Deducting its net debt of $628 million, we arrive at a net asset value of $770 million. Divide this net asset value figure by 43.8 million of outstanding shares, we can derive the net asset value per share value of $17.58. The reason for me to trust using this 6% cap rate to estimate the valuation of Whitestone's properties is due to the recent acquisition of Wing Garden Realty by Kimco Realty. The transaction was done at a cap rate of around 5.8%. So this gave me the confidence of using 6% cap rate to estimate Whitestone's net asset value. To sum it up, I think Whitestone presents an interesting investment opportunity with an upside of more than 50% if it recovers to pre-COVID levels eventually. Meanwhile, enjoy the dividend yield of about 5% paid on a monthly basis. Moreover, management has laid out a good amount of acquisition and development opportunities in the pipelines that are yield accretive, and that should continue to add to shareholders' value. So I have started to add some positions of Whitestone REIT to my portfolio, and perhaps will add more when the price corrects downwards. Let me know your thoughts on this and share with us in the comments below, and consider subscribing to our channel if you think what I share with you today is useful. In the meantime, check out the recommended videos here to continue learning so that you can make better investment decisions. Keep learning, and I will see you next time.